Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, October 11th, 2024. Even though the S&P 500 index hit an all-time high this week, the tension in the stock market is palpable. It is also visible in the behavior of the CBOE Volatility Index, or so-called Fear Index. Over the past 3 weeks, the VIX has steadily risen and is well above its average reading this year. So here's the VIX year to date. Now you have this one huge spike back in early August when there was a concern that the global economy was about to really slow down. And once that was alleviated, you can see the VIX drop down. And you can see, with the exception of that one huge spike, that it tends to bounce around in the low to mid-teens. Now, since that big spike, it's now sort of bouncing around kind of a higher average. And as you can see, it rose above 20 a few days ago and has stayed in that range. And the average reading year to date, I just calculated this yesterday, was at least the average closing level was right around 15. So that's a statistically meaningful variation from the mean. Now it's also curious, since the people driving the stock market higher, namely institutional portfolio managers, are the same people buying a lot of put option contracts on the S&P 500 index that will only increase in value if the stock market goes down. In short, they are bidding up the price of stocks and are willing to pay more for the safety net provided by the put options they purchase to protect their profits. So, at least from a balance sheet perspective, the gain they realize, say over here in their equity holdings, is greater than the cost of protecting that excess gain by buying put options. So it's something most individual investors don't do, but a lot of professional portfolio managers do it. And not only is there nothing wrong with that, but it makes a lot of sense too. Most institutional investors have huge unrealized capital gains in their portfolios, especially in large cap stocks, that they would like to protect at least through the end of this year. So if they sell them next year, the tax hit won't really come around until April of the following year. So using put options as insurance is one way to do that, since those same stocks dominate the performance of the indexes that the put options are purchased on. So the VIX rose above 20 last week and remained there this week. That is, as I said a minute ago, that is considerably above its average reading around 15 and is indicative of rising tensions on Wall Street. Most of those tensions are due to a concern that the upcoming round of Q3 results may not live up to expectations and/or include pessimistic guidance for the remainder of this year. Quite frankly, that is always a concern that recurs every 3 months on Wall Street. An argument can be made that this year is different due to mounting hostilities in Ukraine and the Middle East, China's weakening economy, and social unrest surrounding the general election in the United States next month. Those are all valid concerns. What is no longer an immediate concern is inflation. Yesterday's Consumer Price Index report for September showed a 0.2% increase in headline CPI and a 2.4% growth rate over the past 12 months. That is the lowest that number has been since February 2021, during the kind of the heart of the pandemic. So we've really come a long way in, say, 3.5 years. With the economy expanding at a faster pace than expected during the second quarter and job growth greater than expected last month, I believe the Fed's next move will be a quarter-point reduction in its policy rate when it meets next month, instead of another half-point cut like it did last month. That is also what the bond market seems to believe. This week, the yield on the 10-year Treasury note rose above 4% for the first time since early August. If bond traders believed that another half-point cut was on the way, the yield on the 10-year Treasury note would be around 3.5%, which is where it was 2 weeks before the strong jobs report for September was published. So here's the year-to-date chart on the 10-year Treasury note yield. And you can see at the start of the year, it was up around 4.5%, then dropped down, rose back up to above 4.5%, then took a long slide down. But really, for the past 3 weeks, has been on the uptick, and that's because a stronger jobs market than was thought even a month ago, plus an economy expanding faster than was thought a month ago, with inflation still coming down. It just doesn't make sense for the Fed to cut rates a half point unless some new data point arises in the next 2 or 3 weeks. But short of that, really the move to make is just to kind of cut them a quarter point and continue to just watch how all the other macroeconomic data plays out. So that's my take on the market this week, and I look forward to talking to you next week. Thank you. Bye.